All right, welcome to the second educational video on the spring enrollment where we are going to be touching on candle signs. But before we go in depth on candle signs, we need to be able to understand the previous video. And the previous video was about first things first. So a quick little refresh right here, a quick little refresher about the first things first is we went over the foundational levels. And when we went over the foundational levels, we understood that the bias is the absolute first step in getting to a trade ID, where we want to be able to define things as well. So defining the bias is then understanding that the drawn liquidity and the direction are the two parts of the bias. So bias is understanding the drawn liquidity and the direction. Drawn liquidity is understanding a target. The direction is understanding, are we going higher, are we going lower? Because the drawn liquidity being the target leads to that direction. The drawn liquidity is always a PD ray because a target is always a PD ray. A PD ray then again leads to that direction. We have to figure out which PD ray we are aiming for next. So which PD ray are we going to trade towards next? That leads to the understanding of order flow, because order flow is unloading of orders at previous PD rays and adding new orders on previous PD rays as well. So which PD ray are we going to trade towards next, leading to order flow? That leads to understanding the drawn liquidity. That leads to then understanding the direction. But we now need to understand, all right, we can understand somewhat what the PD rays are, etc., which one we might trade into, but what are the actual types of direction that we are dealing with? Which is where we need to understand the two types of direction. And the two types of direction is candle direction and order flow. Candle direction is candle signs. Order flow is a more zoomed out. So what I mean by that, candle signs is focusing on what can the next exact candle do. Order flow is more what can the next 3 candles do? What can the next 5 candles do? So first we're going to zoom in and see what a specific candle can do. After that, on Friday, so the next educational video, which is about order flow, we are going to dive into what can the next few coming candles do as well. So going over candle signs, which will help us in understanding direction of which PD ray we are actually aiming for, then we first need to understand as well, or have a basic understanding of timeframes. We're going to have a separate video about timeframes as well, which is fully dedicated to timeframes alone. But first we need to have a quick basic understanding. We start on the highest time frame. So what I mean by that is the list you are seeing here starts with the monthly, then the weekly, daily, 4 hour, 1 hour, 50 minutes, 5 minutes, and then the 1 minute. The higher the time frame right there, the stronger the time frame as well. So we always want to start on the highest time frame, which is the monthly time frame right there. I would advise stick to these exact time frames. You do not need the 30-minute time frame. You do not need the 2-week time frame, the 3-month time frame. It's all irrelevant in my opinion. You just need to stick to the basics right here, in my opinion. That would be my advice. So why we start on the highest time frame is again because it's the strongest time frame. So ideally, when we work our way down, everything should be in context of the higher time frames. So if the monthly is going higher, aiming for a premium array, for example, then we do not necessarily want to take shorts on the 1 minute, unless of course under very specific conditions. But these time frames should be in context. And when every time frame is in context of one another, they're all aiming at the same premium array. That is extremely high probability for us to then look for trades. So before we dive into the 1 minute, we need to understand or have a brief understanding of what the monthly is doing. Before we dive into the 5 minute, we need to have a brief understanding of what the weekly is doing, for example. So that is very important, understanding the time frames. Starting on the highest one, then working our way down. Now, we can dissect those time frames. So when we dissect the time frames, we have higher time frame, we have mid time frame, and we have lower time frame. Higher time frame is red, mid time frame is black, lower time frame is blue. And the higher time frame right there is monthly, weekly, daily, and the 4 hour. The mid time frame is the 1 hour and the 15 minute. The lower time frame is the 5 minute and the 1 minute right there. That is how we dissect the time frames a little bit easier to understand what we are referring to when we refer to the higher time frame or the lower time frame or the mid time frame. Then from those time frames, again, which we're going to dive into more in depth later on as well, we now need to understand, of course, the basis of candle signs. The basis of candle signs refers to respect and disrespect, because those respect and disrespect tells us everything we need to know about what the next candle likely will do as well. So what is respect? Respect, and when we refer to respect of a candle, the PD array that we are coming into is being respected, meaning it's wicking price action. So for example, this line that we are seeing right there at the bottom of our screen, we have a candle coming into that, and we have a long wick at the top right there. That line is, of course, a premium array. So when we come into a premium array right there, and we have a long wick at the top right there, it indicates to us that we are respecting that PD array. Then we can understand eventually how that leads to the direction of the next candle, which we're going to go over after this. Then we also have disrespect. And disrespect is the exact opposite of respect. So PD array is being disrespected. It's a big body. This right here is again that premium array. The exact same scenario like we saw with the respect right there. But now we have a big body going higher. That indicates that we are not respecting that premium array. And that has a different story than to the overall direction. Now, why do we use this and why does this work? This is where we also need to go over order flow a little bit, because we are looking currently at higher time frame order flow. When we now zoom in on that specific candle, we will see order flow on the lower time frame. And what that exact order flow is what we're going to go over in the next video as well. So that's understanding the candle signs and order flow. They again go hand in hand as well. But we first need to go over candle signs right here before we can dive into order flow a little bit deeper as well. Now, with this basic understanding right here, how can we then use this to our advantage? Because how can we now understand the direction? What do these candles tell us where we want to trade towards next? That is now where the candle direction comes in. And in candle direction, we again have the respect. So for the next candle, price will continue in the direction of the respect. So with the premium array we saw in the previous slide and the respect of that candle, what is the direction of the respect? It's bearish, right? We are respecting a premium array. So we can continue lower on the next candle as well until we reach the next PD array. So the first discount array in that sense. And then we see again, what are we doing? Disrespect is the same thing. Only thing is, it's opposite. So for the next candle, after we come into that premium array and we are disrespecting it, price will continue in the direction of disrespect until we reach the next PD array. So what does that look like? Well, going back one slide, then right here, we would expect for the respect, we would expect right now the next candle to be a bearish candle, not coming back above that rejection high right there. So not coming back above the first candle high sitting right there. For this disrespect candle, we would expect for the next candle to actually continue higher and to at least reach the previous candle high, because that's the first premium array that we then encounter again. So after we disrespect that previous candle high, we can then look at again a new premium array that is a little bit higher. Where right here on the respect, we can look at the discount rate, which in first instance is again the previous candle low. Now, then again, going over the candle direction, that respect and disrespect leads to a 2-candle rejection, where respect and disrespect is extremely general. And in general, it tells us a lot, but it does not tell us enough. It does not tell us all the small little secrets that we need to know. That is where the 2-candle rejection comes in. When we have, for example, a daily fair value gap or daily order block higher, let's make it easier, a daily bullish order block, discount array in that sense. Then on the same time frame, with that daily order block, we want to see a 2-candle rejection on the daily time frame. That 2-candle rejection is the following: 2 candles to create a rejection. If the rejection fails, the PD array will fail. If the first candle is a rejection, the second candle will respect the first candle, will continue lower, for example, or continue higher. The first candle is not a rejection, so is a disrespect candle right there. The second candle will sweep the high of the disrespect candle or the low to then continue higher or lower. So again, referring to the previous slide right here, let's say this premium array is a daily bearish order block. It can be any bearish PD array. But we are looking at the two candle rejection on the same time frame. Ideally the same time frame or one time frame below it. But those time frames don't go too far apart, because then of course this is not working based on candle signs. Then it would be based on order flow instead, which we're going to go over in the next video as well. So looking at this premium array right there, we can again assume that's a daily order block, the daily bearish order block. We come into that with the first candle, then understanding that the next candle right there is going to be a bearish candle, should be a down candle right now, because that is part of the second candle rejection. The next candle is bearish, is a down candle right there. If that does not happen, if it's an up candle, or if we take out that high right there, then we are going to continue higher and we are going to see a straight into a next premium array that is higher as well. That is the two candle rejection, where we're going to have more examples of this as well, where if the first candle after this candle is a down candle, then the next one is an up candle, same exact thing if it takes out the rejection. The disrespect candle right there, this is where we can still sweep the previous candle high right there to then continue lower. If we disrespect that, that is exactly when we can expect higher prices as well. So why do we view that from a two candle rejection? Because the rejection here already happens, where the disrespect can also still happen, but then on the next candle instead. So what does this look like? And let's go over a few case studies to go into live examples actually, to train our mind to actually see these rejections right there. With the first case study, I want to go over ES, the E-mini S&P 500 right here. What you're seeing is a screenshot of my phone that I took last night actually, because I want to go over live examples right here. So I want to show you my exact thought process in a live market as well, where I wrote down, we will trade back into that gray box, that fair value gap right there. From there, monitor the two candle rejection. Now, leading up to that, we see again the lines right there, which we can recognize from the previous video actually, because those are the lines that we ended the video with, the PD rays that we ended the video with. We can ask ourselves two questions from this case study. Will we trade back into an FVG right there? That is how we can use candle signs to our advantage, because we can understand when we want to trade back into a fair value gap. Will that fair value gap hold? That's also what we can understand based on candle signs. So that fair value gap right there, eventually I got to the understanding that that fair value gap will not hold. And how did I get to that understanding? And how did we overall lead up to this situation right here? Exactly what we're going to go over right now. All right, here we are on ES, the same exact price action right there. I've used the replay tool to show you and how we can study the candles. If we take a look at the daily first, then again, what we did in the previous video, we went over all the daily PD rays and we went over all the 4-hour PD rays right there in close proximity. So where price is close to overall. Now, of course, ideally, when we start, we want to start with a monthly and a weekly analysis as well. I'm going to skip them right now because this is more of a live example as well. If we want to go over the monthly, it might take another month before we have the result, right? So to get the result a little bit quicker, we're still going to stick to the high time frame, but in this case, the daily and the 4-hour for this exact example. Top-down analysis, how you want to do that, exactly what we're going to go over in later videos as well. So understanding this concept right here is again understanding first all the PD rays. So that's why in the previous video we went over all those PD rays, because when we then come into those PD rays and we then see the respect or the disrespect, we can very confidently say, will we respect that and will we continue higher or continue lower, or disrespect that and we will continue higher or lower again. That is also why it's so important to understand do not at any, I can't emphasize this enough, do not under any circumstances incorporate any other PD array. No inverse fair value gaps, no reaper fair value gaps, no reclaimed order blocks, whatever it may be, nothing else, because that will ruin candle signs right here. It's very important to understand. And that's with a lot of things. So again, quick reminder, simply copy whatever I'm doing and you will see the best results. Now, right here on the daily, I first want to go into the 4 hour, because before we actually have that previous day high sweep right there, I want to go into the 4 hour, how we can actually see that. Here on the 4 hour, we have this fair value area, we had this daily fair value gap right there, we have a nested order block sitting right there as well. Then in close proximity, so even closer to the recent price action right there, we have previous candle low, previous candle high. When we come below this previous candle low, what are we seeing? That previous candle low is again in itself a discount array, so a PD array, right? So if we want to know what the next candle likely will do there, then we can see that simply understanding the previous candle low, previous candle high as well. When we come below that previous candle low right there, we see a long wick. What is that long wick? That's a respect candle. That is respecting what? It's respecting the previous candle low sitting right there. So what can the next candle most likely aim for? Well, we are respecting a discount array. Order flow wise, if we are respecting a discount array, we can then understand that we might want to trade into a premium array next. What is the next premium array? Right here. This previous candle high. So the next question on, well, the next question on the next candle is, will we reach for the previous candle high or the previous candle low right there? Well, we are respecting a discount array in the form of the previous candle low. What is more likely to happen? Previous candle high right there is the target. So the next candle we can trade towards that previous candle high right there. Now it gets interesting, because now if we remove a few things, we have this previous candle high, which was the previous premium array, and we have this swing high right there as well, which is also a premium array in itself. At this moment in time, we are respecting this premium array, but we are disrespecting the previous candle high. Why? Because we are closing above that previous candle high right there. So we are disrespecting it. If we were to respect it, then again, we would see the same thing right there. We will close above right there, the previous candle low, and then close below the previous candle high. So this indicates to us, again, if we mark out the previous candle high and the previous candle low on the new candle right there, what are we doing based on the previous candles that we saw? We are now respecting the premium array right there, but we are disrespecting the previous candle high right there. So we are not necessarily disrespecting any discount array. So overall, I would still say we are in this sense still bullish. What can we aim for after this previous candle high right there? We have this daily previous candle high right there, previous daily high right there, which is in itself also a premium array. So right here, we can potentially look at aiming for the previous daily high right there first and the previous candle high right there first. And as we see, we come into that first. So to show you it right here, going into the low time frame, we first reached those premium arrays before we then continued lower. Now this is where, again, it gets super interesting, because now if we look at these previous candles on the daily and on the 4 hour right now, what are we doing? We are sweeping this previous daily high right there, which on the 4 hours is a swing high as well. Then we're also sweeping the previous candle high. Why are we sweeping it? Because we are respecting those liquidity points. Again, previous candle high, previous candle low, swing points, they are liquidity points, right? Like we discussed in the previous video. So right here, we can see that we are respecting those premium arrays, which indicates to us, all right, we're now closing below as well that previous candle low. This is a great indication that the next candle can now aim for the previous candle low, but after that, for this discount array as well, after that, for the fair value gap as well, after that, potentially for the fair value area right there. So right here, if we skip a few candles again, then right here we see the same thing. closing below, disrespecting those discount arrays, which indicates to us, again, that we can now continue lower and target next discount arrays. Because if we are disrespecting discount arrays, then we can continue in the direction of the disrespect, meaning we can continue lower, target lower discount arrays. If we are respecting premium arrays, then we can continue in the direction of the respect. The direction of the respect right here is bearish, right? Because we see a huge wick at the top right there, which indicates that we might want to do the opposite and target then discount arrays. So right here, we do the same thing with the next candle. And we can confidently say that we likely want to aim for this daily fair value area, potentially even the nested order block right there. Again, the further the PD array, the lower the probability, right? So the previous candle low, previous candle high is always the highest probability target. But after that, it can still be high probability when we have the dominoes effect. And the dominoes effect is what we're going to go over later on in this video as well. So right here, what do we see? We see right now that we have another close below that previous candle low. Now this is where it gets interesting, because now we are also leaving behind a fair value gap, which we have to take into account. That is also a premium array, right? And when we leave behind that fair value gap right there on the 4 hour, can we trade back into that fair value gap? Well, how do we know if we want to trade back into a fair value gap? As a general rule of thumb, we want to look at, do we close below the previous candle low right there? If we do not close below it, then we can most likely trade back into the fair value gap. If we do close below it, then we are likely not trading back into that fair value gap right there, which it then becomes a breakaway gap. Breakaway gap, also what we're going to go over. Breakaway gap is a fair value gap that is not getting traded back into. So it's almost like a fake fair value gap. So this is one method, but it's more important to look at the rejection that we might have at the bottom right there. Are we currently rejecting? Are we respecting something right there? Not necessarily the previous candle low, but are we having a long wick at the bottom for that to then become a fair value gap because we are respecting something at the bottom? No. Okay, so we can continue lower right here on the next candle as well, not expecting a retracement into that fair value gap. Afterwards, right here, we come into the fair value area. And this right now is also where it gets super interesting. Does it look to you like we are currently respecting something? I would argue that this long wick is respecting something. Why is there a long wick right there? That should be suspicious to you. That should be like, why is there a long wick? Aha, okay, we already had marked out all those different PD arrays right there. We are coming into a fair value area right here on the daily. That fair value area is what we can continue higher from, where either on the daily time frame or one time frame below it, not more than that, we want to look at the 2 candle rejection right here. Is this candle already rejecting? Yes. Why is that a rejection candle? Because that in itself is a long wick at the bottom right there. So when we have that rejection candle right there going higher, this area is the rejection right now. That wick at the bottom is the overall rejection. When the first candle rejects, the second candle respects. What that means is if the first candle is already a rejection off of any PD array, then the second candle will respect whatever the first candle has done. It's the highest probability thing to happen. If that does not happen and we take out the rejection, then we can say again, all right, and the rejection low right there is this previous candle low. Then we can say we are aiming for this area right there. But that also leads to the understanding that we are aiming a lot lower. Why a lot lower? That's also what we're going to go over later on. Now, right here, we want to then see this next candle be an up candle right there, because it should respect the rejection that already happened. So the next candle, if we want to continue higher, should be an up candle to continue higher right there, following through on the rejection. If the next candle is a down candle or takes out that low, so there's 2 criteria right there, then we will continue lower towards a lower discount array as well. So right here, we see the next candle is a down candle right there. Okay, that makes it even more suspicious. I think we might want to continue lower and disrespect everything right there currently, because we are not following through on that rejection going higher right there. So the rejection fails, the potential confirmation to continue higher fails right now. So all the discount arrays right there will likely also fail. Why do all the discount arrays fail right there? Well, let's go back to the previous video where we talked a little bit about the fair value area. On the daily right here, this fair value area right there is that line. We're sitting right there. When you find the fair value area, or you find an order block, you find a fair value gap on the time frame, on the daily in this case, then you want to stop right there. The 4-hour nested order block is another confluence. It's another confluence. It's not the most relevant part right there. The most relevant part is the daily right there, because that's the first time frame we come by where we see something like a fair value area, a fair value gap that we can potentially continue higher from. So right here, when we then want to offer fair value, we will come into this line to then continue higher off of, which is the exact spot where we got that rejection right there. So here it's offering fair value right there to then potentially continue higher on the next candle, because that is the rejection, right? So if we want to continue higher, the next candle will want to continue higher already and will want to be an up candle at least. Can be a small up candle as long as it's an up candle right there. So if we do not do that, then the rejection fails, which also leads that we are not offering fair value anymore, which then we are most likely targeting liquidity in the form of those lows right there. Where then the drawn liquidity all of a sudden becomes very clear, because then we have a lot of candles to deal with right there until we reach those lows. Now, do we want to take out the lows? Let's see. This next order block, again, an extra confluence, not necessarily something that is super interesting to trade off of, because we already had the daily fair value area right there. Let's study every next candle right here. Again, a huge candle going lower right there. What can the next candle aim for? Previous candle low right there at least, and potentially even the liquidity right there. Then we get this. We get a candle like this right here. After coming below the previous candle low, we now see a respect of the previous candle low right there and a huge wick at the bottom. And also this now leaves behind a fair value gap right there. So now it becomes interesting. Now we have arrived at the case study, at the screenshot that I made last night, where we saw I mentioned this fair value gap, and I said we want to trade into that fair value gap, and I said it with a lot of confidence, as in I can guarantee you we want to trade into that fair value gap. Can I guarantee you that we want to continue lower right there? I think the highest probability thing for price to do right there is that we want to continue lower off of this 4-hour fair value gap then. But is that guaranteed? No. So what do we need to do? We study the 2-candle rejection. We monitor the 2-candle rejection again. So right here, once we trade into that right there, and we study the 2-candle rejection, then right here we already see somewhat of a rejection. It's a huge candle going into this fair value gap right there. So if we get comfortable right now above this high and we start to run this high, difference between a run and sweep again, if we now start to close above this high right there, then I would argue again, the rejection right there is failing. So the rejection is taken out to then continue higher instead, meaning that we do not want to continue lower off that 4-hour value gap. We can aim for another premium array sitting right there, where eventually we see this. We arrive at real price action, at real time price action right here. Right here, we see this candle closing above the previous candle high, taking out the rejection. That's the most important part. After that, we also see a long wick at the top right there, which might indicate that right there we want to trade into this 4-hour value gap to then instead continue higher off of that. So the next candle can do what? Can trade into this 4-hour value gap sitting right there to then respect that candle right there to continue higher off of that, which is where we are currently seeing this exact candle. What is this exact candle doing? this exact candle is a disrespect candle, again, continuing higher, where currently we are looking overall at higher prices, I would argue. So where the original idea for me was to look at lower prices, I then switched to long IDs right there. Now, I do not want you to believe me, as in I do not necessarily want you to believe that I switched to long IDs right there, just purely based on the theory that I had right there. So that is why I will show you that both in the short side right there and the long side of this price action, I had trades and they were both profitable trades. So if you go to on the website to Ario's trades, then you will see both trades right there. Where based on this exact ID sitting right here, I went into the lower time frame, which we're currently not going to do because we're not looking at entries just yet. I went into the lower time frame to then look at a trade ID, which played out as well for both shorts and the longs, both winners. So that is how I can show you that everything right here in real time works. So the next thing right here that I want to go over is the next case study. And the next case study is then understanding. Let's actually first answer these questions right here. Will we trade back into an FVG? You can understand that now by the third candle that gets created. What is that third candle doing right there? The third candle of a fair value gap. What is that doing? Is that disrespecting something? Is it respecting something? That is very important. Will that fair value gap hold? Also what we saw, right? When we came into that fair value gap. Is the rejection failing or is the rejection actually holding? Very important to understand. Then the next case study is an Australian dollar, US dollar case study right here. Where the first thing we are looking at is a daily time frame on Australian dollar, US dollar. Again, took the screenshots on my phone again last night. Then we see we are coming below this low right there, that swing low, and we have a respect candle. And I immediately mentioned right there, this line is now the target. This line right there is now the target. And then after that, we see the same exact thing on the 4 hour where the sweep happens, but again, it's a daily swing low, right? So ideally, I want to look at the daily right there to look at the rejection, at the respect, at the disrespect of those candles. On the 4 hour, and why I mentioned the 4 hour here on the right side, is because the 4 hour leaves behind a fair value gap right there, which is in itself a discount array, which we can continue higher from right there. So the question that I wrote down was as well, is it a sweep or a run on liquidity? And what then is a sweep or a run on liquidity? Right here, we are on Australian dollar, US dollar on the exact case study that I showed you as well. This line right here was eventually the target right there. And what do we mean with, is it a sweep or a run on liquidity? What is a sweep on liquidity? A sweep on liquidity is when we, like mentioned, a sweep. So we sting into the liquidity and we immediately retrace back above the liquidity to then target opposing liquidity in the form of swing highs after sweeping swing lows. If it's a run on liquidity, we will just continue. So for example, this high right there, those swing highs, we are running this liquidity right here. Why? Because we are continuing higher right there. And you can probably tell already what makes the difference between that sweep versus that run based on candle signs. It's a close above swing highs right there, and it's a wick below swing lows right there, respecting discount arrays, disrespecting premium arrays, which leads to a sweep at the bottom and a run at the top right there. Now we still have 4 hours to say we actually close above this swing high, but if we get a retracement right there, I'll owe you 100,000 euros because that will just not happen right there. We can already confidently tell that this right here is a run on liquidity when we are that high in the leg right there. Now, looking at this price action more in depth then once we come above this, once we come below this low as well, sitting right there, and we have a wick in the making like that. The theory is, again, that if we want to continue lower, we will have fair value areas, which is this one right there. That is the fair value area, which we can continue lower from. So at that moment in time, at this moment in time already, we come back into that fair value area. And what do we see? Do we see a rejection right there? On the first candle, I would argue that this wick right there is again somewhat of a rejection. All right, if we do not agree with that, we can wait for the second candle. If the second candle comes above that right there, then we should sweep that previous candle high, the previous 4-hour high right there, to then continue lower off of that. All right, in both scenarios, that does not happen. We do not have a down candle. We do not sweep that previous candle high right there. So we are not respecting this fair value gap. We are overall not respecting now the fair value area. The market is always doing one of two things. And the market is either offering fair value or it is seeking liquidity, which is a topic in itself we're also going to dive deeper into. But when the market is not offering fair value anymore, it is seeking liquidity. So right here, is it still offering fair value? Well, there is no fair value to be offered above this line right there because this was the fair value area. So if it's not offering fair value, it is doing what? It is seeking liquidity in the form of those highs right there. So then eventually, what do? We now see a down candle. What is that down candle doing? What is it aiming for? It is aiming for a fair value gap sitting right there. All right. Once we come into that fair value gap right there, what do we see right here? We see a wick at the bottom again right there. What is that? Respect. That's respect right there of that fair value gap. So the next candle, can it take out this low? Can it take out that rejection? If it does, and it can, it definitely can. If it does, I would expect lower prices right there. If it does not, then we are definitely going to continue higher right here. Where eventually, I mentioned, this line is the target right there based on the candle signs we saw in this overall price action schematic. Now, right here, to show you again that it works in real time, I did the case studies, but I also took the exact trade right there where I took on the 1 hour a trade ID continuing higher, and my entry was around here covering those lows, and it was around 1 to 2 right there, which also again played out. So again, you do not need to believe me, but the results I'm showing, and if you start to study this for yourself, then you'll see it works. Now, eventually, what can the next candle do? Close above premium raise, again, disrespecting premium raise, still respecting discount raise, then it can run for this exact high right there, which an early giveaway or an early sign that we wanted to continue higher towards the high was already seeing that this fair value gap and the fair value area was not getting respected right there, based again on candle signs. So where now we are going to move on towards the next case study, which is right here, the silver case study. And when we look at the silver case study right there, we see the first question, will we trade back into a fair value area? Will we trade back into a fair value area, or will we already continue higher right there? In the first screenshot I share is the fair value area is now the target. Monitor 2-candle rejection there. Where we can see the fair value area right there, we have a fair value gap as well, a little bit higher. And we have that swing high that we just came above, which we are currently respecting, like we're seeing. After that, I mentioned this 4-hour candle here, this 4-hour candle that is currently in the making, that most recent one, should be an up candle if we want to already continue higher. If that does not happen, and if it's a down candle, or we take out that low right there, then we will guaranteed trade back into the fair value area. Then, by taking out this low right there, the low that I had marked out right there, we confirm the move to the fair value area, or, and as well, the second criteria, again, like I mentioned, or if that candle is a down candle and closes as a down candle, then we also confirm that we will trade back into the fair value area. Now, why is that? And how do we know this? If we go to silver and we take a look at silver, then we again see the exact same PDRAs that we have marked out right here. And we also see that we are already continuing higher off of the daily fair value gap that we actually have right there. And we did not trade back into the fair value area. Why? Let's see. Let's start right here. We close above this fair value area right now, indicating that we are disrespecting premium raise again, and we are potentially respecting discount raise. So right here, when we then come into the next premium ray, which is the swing high, we have the previous candle high, but more importantly, again, that swing high right there, and we then see a huge wick. But what are we leaving behind? Why are we respecting something right there? We are respecting because we now have order flow. We are unloading orders right there at premium arrays. We are now adding new orders at discount arrays right there. And that is exactly what we are seeing right here. So the candle signs tells us that this next candle most definitely wants to trade back into the daily fair value gap right there. Purely based on that we are respecting a premium array right there, trading back into the discount array is the next most likely thing to happen right there. Now the question becomes, on the 4 hour, do we want to come into the fair value area, or do we already want to continue higher off the fair value gap itself? Well, let's look at candle signs. This 4 hour candle that we are currently seeing is coming into that daily fair value gap right there. And when it comes into the daily fair value gap, we see again the rejection already. So when the first candle rejects, the second candle respects. If that does not happen and the first candle is not a rejection, which in this case again is not the case, the first candle is a rejection, and we're seeing that again based on candle signs, and the second candle should respect, should be an up candle. If it's not an up candle or it comes below this low right there, then we will trade back into the fair value area sitting right there. And at the fair value area, we will do the exact same thing. So right here, the next candle should be an up candle if we do already want to continue higher. Which, what do we see? We see that next candle be an up candle. Perfect. All right, we do not come into the fair value area. But what can we do? We can just simply react. We are constantly reacting right there to what the candles are doing. Is the rejection failing? Is the rejection not failing? If the rejection here was failing, we were supposed to come below that low right there and create a down candle. Then we can say we are heading lower. If the rejection is not failing right there and the rejection is actually holding, then this down candle, the rejection in itself will already hold, and the next candle will be an up candle right there. Which then what do we do? Well, what is then the next premium array after that to be the target? Well, a clear premium array that we actually have sitting right there is that fair value gap. We have this overall breaker block sitting right there. And we have as well sitting right there the previous candle high. So what do we see right here? Well, if we want to continue lower right now, then we can definitely sting into this fair value gap right there. And then we want to monitor again the 2 candle rejection, where what do we see? We come into that and we create a down candle. Okay, now it gets interesting because we again have the same scenario right here with this daily fair value gap. We now see it with this 4 hour fair value gap, where we already have the rejection. First candle rejects, second candle respects. All right, perfect. So the next candle should do what? Next candle should be a down candle, should continue lower because this should be respected right there. The rejection should be respected. If we trade back above this high, we can already confidently say that we are not going to continue lower. And now it becomes very interesting because when we trade back above this high, the rejection fails. That means that this fair value gap is likely not going to push lower. That means that we don't have any other premium arrays sitting right there except for this swing high right there. Meaning that creates a dominoes effect where all of a sudden we have this whole area where we can trade towards until we encounter a next premium array where we need to monitor the 2 candle rejection again. This is exactly what makes this so magical, because when you understand this factor right here, you will see in my trade recaps, you will see every single thing I do is a lot is based on candle signs, where if you master this, and I would highly advise to maybe if this video is a little bit complicated for you, watch it 500 times if you need to, because if you master this, you will become one of the best traders in the world. I can confidently tell you that. And what I mean by that is you can go into the 1 minute eventually and you can look at this and you can simply trade the next candle. Where right here, if we look at the 4 hour, for example, I do not need to go into the lower time frame. If I see a trade ID right here, I could already, for example, this in itself is already a trade ID right here. And that is the most advanced thing you will ever see. Well, that's maybe an exaggeration, but this is extremely advanced things right here. But first we need to understand the basics. So again, this is very important to understand. Now, right here, next candle should then again, simply said, be a down candle. So it's constantly a process, right? It's constantly a step-by-step thing. We're coming into a premium array, monitor 2-candle rejection. We're coming into a discount array, monitor 2-candle rejection. Are we respecting? Are we disrespecting? Based on that, what can we do with the next candle? So right here, next candle should be a down candle. Next candle is an up candle. And as soon as it takes out that high right there, you can already look at longs right there and potentially even earlier. That is where we need to go over different videos. Then this right here is again what? It's a disrespect right now. So now we expect this swing high to be traded towards right there. And eventually we see that we continue higher and we arrive at real time as well, sitting right there. And we reach that swing high sitting right there. That is how you go over those 2-candle rejection, monitoring those 2-candle rejection, the respect and disrespect. But we're not done yet. We're going to dive into this as well. Not necessarily a little bit deeper, but just more examples. Now, if we go over the next example, and we go over the next slide right there, will we trade back into a fair value area? Again, we see that through overall understanding the candle signs. That is why, if I'm making a forecast, oftentimes you'll hear me say, all right, but I want to react, etc., to whatever we want to do, or I want more confirmation, etc. That's me waiting for candle signs right there. And when we get candle signs, then that is reacting in that moment in time. Where initially I might say, well, I'm expecting a fair value area right there to be the target, and we can trade back into that, and we can continue higher off that. But if that happens on the 4-hour, you react. You want to react, and you want to switch that. So right here, moving on from the silver case study, we now see the next thing. Will we sweep? Based on candle signs, we can basically always have a good idea of what we are likely going to do next, at least the next candle, and based on order flow, the next coming candles. Will we sweep is then a question that rises, because what is a sweep again? Previous X low or previous X high sweep, which again is also those swing points, right? Swing point sweep. When the first candle doesn't reject, that is when we can expect a sweep right now. Then the next thing is when we are in for retracement after a low high or low or a high close. So what are these two different things? I'll show you exactly what I mean as well. Right here, we are on GBP US dollar, and we are looking at the 4-hour time frame right here. On the 4-hour time frame, we see this 4-hour fair value gap that we have. And when we come into that 4-hour fair value gap, we also see that first candle coming into it right there is not necessarily a rejection higher already. Why is that not necessarily a rejection higher? Because it looks like a disrespect candle, right? It looks like we have a low close in that candle, in that fair value gap as well. And the candle, relatively seen to the wicks, is a low close. We do not have a long wick at the bottom overall. This is when we need to understand how PD arrays work. As soon as we trade into a PD array, I'm going to ingrain this into your mind because it's extremely important to understand. This is also the reason why I do not use 50% of fair value gaps, why I do not use 50% of order blocks, of breaker blocks, because it's irrelevant. Because this is already incorporated into the trading plan. Because right here, how can we know we still want to continue higher? The discount rate that we currently have is not the fair value gap anymore, because we are not rejecting off of that currently. So the fair value gap alone can be forgotten about. We are not using the fair value gap there anymore. But we do have another discount array that is still sitting inside the fair value gap, which is what? Which is the previous 4-hour candle low. This right here is now the next discount array that we can continue higher off of. If we do not continue higher off of that, and if we do not respect that previous candle low, then what will we do? We will aim for a lower discount array, which might be at this moment in time, this fair value area right there. So how can we expect a sweep of a previous candle low, a previous candle high, when the first thing, how we can expect a sweep, is when the first candle, when coming into a PD array, does not reject just yet. That is when you can expect a previous candle low, previous candle high sweep to then continue higher or continue lower off of that. In this case, of course, continue higher off of that. How do we know if it's a sweep? When we reject back above that previous candle high right there with a long wick at the bottom, and now we have the rejection. So now we can confidently say right here, if we want to continue higher, we should definitely not trade back below that low right there, and the next candle should be again an up candle. Now here it gets very interesting because you can constantly refine that with the new candle as well. If this candle right now is the new rejection, then this rejection is respected. This rejection right now higher should also be respected. So those candle lows right there should now be respected unless we get, again, same premise, a low close and we start to, the first candle does not reject right there. So the next candle should be respected right there. Perfect. Next candle right there. Perfect. Also, again, every time we see those get respected right there. And that's exactly what we are looking at when we expect a sweep of a previous candle low. The first criteria is, again, that when the first candle does not reject just yet, and we cannot expect the second candle to respect the first candle, then we can expect a sweep instead. So the first candle being a disrespect candle right there. And then if it's not a sweep right there, and if we were to close below that low, then again, it would be a run and we can expect lower prices as well, continuing lower towards a next discount array. Now, looking at the second one, the second criteria that we had, when we are in for a retracement after a low/high close, what does that mean? What do you mean with that right there? Well, if we take a look at ES, on ES, we saw this sweep of that high right there before we actually continued lower. This phenomenon is, again, fractal. This happens a lot of times. Where if we first start off with the monthly right here. On the monthly, we see this previous candle high right there. We have a pretty high close as well. If we now want to create a retracement, then what is the only retracement or the only area where we can continue lower from? It's a previous candle high or previous candle, well, if we are retracing higher, it's a previous candle low. But in this case, the only area where we can continue lower from, this is the only premium rate that we have right there. So here, if we want to sweep that previous candle high right there, then we can continue lower off that, which on the weekly, what do we see? We have the same exact thing. Now it changed a little bit because it's this one right there. That weekly is again high close. Okay, so can we expect automatically that we sweep that high to continue lower off that? No, but it gets extremely interesting when in the same exact moment we create a daily fair value gap sitting right there, and that fair value area which we can actually continue higher from. So when we then have only one premium rate, which is the same previous day high right there and the previous week high, that line, that is the only premium rate that we can continue lower from. Then right there we can expect that if we come above that to be a sweep to then continue lower. How do we confirm that sweep? And how do we know that we want to continue lower actually, and continuing lower as in to then eventually potentially continue higher again off that daily fair value gap right there? Well, on daily we can wait for the daily candle close, but we can also go down one time frame, because on the 4 hour right here we see this 4 hour candle right there with respect of, in this case, a swing high, which was also the previous day high, which is also the previous week high right there. And that is exactly how we can know if we are sweeping that previous candle high right there. With the first indication is that high close, then the second, the confirmation, is when we have that sweep, the respect of that candle right there, and we are leaving behind daily value gap, which is then the next discount rate that we can look to target as well. Then after that, we need to understand as well the opposite of a sweep. And what is the opposite of a sweep? It's a run on liquidity. So will we run? A run right here. A previous X low, previous X high, previous candle low, previous candle high again, and swing point run. So again, we're talking about liquidity when we are sweeping or running something. Now, when we close below or above a liquidity point, then we can talk about a run on liquidity. So it's the exact opposite of what we talked about in the sweep of liquidity, where here, based on, again, the time frames, of course, on the 1 minute time frame, will you close above that high? Yes, but it's either the premium rate right there is on the daily and it's on the 4 hour right there. So you look at the 4 hour and the daily right there, not at the lower time frame. So right here, why is this a run? Because we close below swing low. Why is this a sweep? Because we do not close below that high right there, indicating respect and a disrespect right there. That indicates then again the difference between a sweep versus a run on liquidity right there. Now, how we can view that from an order flow basis is all exactly what we're going to go over in the next few videos as well. Now, the next thing we need to understand is a dominoes effect. So the first thing about a dominoes effect is a dominoes effect. It was a show in the Netherlands, and I'm from the Netherlands, where dominoes is you have those little stones, and when one stone starts falling, the next stone falls, and that leads a domino effect where everything starts falling and eventually it becomes a huge beautiful picture or whatever they created. But basic understanding, you have a stone, that stone leads and is very close to the next stone. So when that stone falls, the next stone falls. When that stone falls, the next one, the next one, the next one, they all start falling. So that creates a dominoes effect. Where right here, the first thing we need to understand is the rejection failed. And if a rejection fails, then that can lead to an overall dominoes effect usually. So what does that look like? Here we are on Bank Nifty, and now let's put everything together and understand where we also need to start. So on the monthly time frame, that is the time frame where we start. And on the monthly time frame right here, I would argue that if we look at this candle right there, we are failing to create a fair value gap higher, which in itself is also not a great sign because that indicates that we have a lack of intention. Does that mean I'm automatically bearish right there? Not necessarily, unless we get very specific conditions. So right here, we still have this candle right there at the bottom, somewhat rejecting. All right, a little bit suspicious. Now, if we want to continue lower right now, then what do we see? We are coming into this fair value gap sitting right there on that weekly fair value gap. Going down the time frame, the weekly fair value gap right now. All right, what is that weekly, the most recent weekly candle actually doing right here? It's rejecting off of that weekly fair value gap right there. So we already have a rejection in the form of the top wick that we see. So what can this aim for? The previous candle low and potentially next discount raise, swing lows right there. So the next candle, if we want to follow through on that rejection, first candle rejects, second candle respects. So right here, if the first candle rejects, the second candle respects and continues lower and is ideally a down candle right there. Perfect. We see that exact thing. We see a down candle right there. All right, nothing to worry about just yet right here. But what now gets extremely interesting and what creates a domino effect right here is that if we want to continue lower, then we should respect ideally this candle right there. Why? Because right here, this right now is the follow through of that rejection. So what we talked about again, the first candle right here rejects. Second candle should be a down candle. Every next candle should have the objective to continue lower actually, because then we are aiming for next discount raise. Where here we are already respecting this previous candle low. All right, a little bit suspicious, but unless we have an up candle or we take out this high right now, that already indicates that we now want to continue higher and we do not want to follow through. So in the meantime, we still expect lower prices, but we have our boundaries. We have our boundaries of if this gets taken out right there, then we will look at higher prices overall. So what do we see? We start to continue lower. Perfect. That's exactly what we would want to see. And afterwards, we start to trade back above that high. That is weird because now we are not respecting the rejection anymore. Every down candle right there should ideally just continue lower and should exactly be a down candle and should not trade back above previous candle highs right there. Unless, again, that first candle that we saw right there was not a respect candle like this, but was a high close inside the value. Then we could have expected a sweep that high. But right now, we would not expect a sweep that previous candle high. So now this creates a dominoes effect. Because now when we trade back above this high right here, what does that indicate? That indicates that this fair value gap is not following through, that now the target can become this premium area right there. After that, we have a few breakers right there, but ultimately we are aiming for those highs right now, because this was the only real place right there where we could still continue lower from. And we failed to do that. And when we fail to do that and the rejection fails right here, we create a dominoes effect where all of a sudden, all the premium rays are now looking to fill. All the premium rays are now starting to fill right there. Because one single premium ray fills, all those other premium rays are likely also going to fill. Why that exactly is also what we're going to go over in order flow right there, but we can already see that based on candle signs. Then right here, eventually we start to create a bullish weekly fair value gap sitting right there with the order block as well. Can we continue higher off that? Beautiful rejection right now. And now the dominoes effect is in full effect because on the daily right here, we see the exact same thing. The daily fair value gap sitting right there. When we come into that, we respect that. The next candle can continue higher off that. Next candle can again continue higher right there. Eventually creating new up candles and looking to take out every single premium rate that is located towards the left, which again creates overall that dominoes effect like we mentioned as well. That is when one PD ray starts to fill because the rejection overall fails, and the rejection fails right there. When that second candle right there gets taken out at the high, the rejection fails, and that is when every other PD ray there starts to fill as well. So from that, we move on towards the next thing, which is again practice. We need to practice this. Especially this concept is extremely important to practice. See it with your own eyes. And when you start seeing it with your own eyes, I can take trades. I can take winning trades. I can show you winning trades. I can show you it working live constantly. But unless you practice it and you see it with your own eyes, it's just not going to work. So practice right here. Same step that we did with the previous video. Mark out all the PD arrays. Then study how candle signs tells the story. So are we respecting that discount array or PD array? Are we disrespecting those PD arrays? What are we doing? So are we monitoring the 2-candle rejection as well? Can the rejection right now continue higher already? Or is the rejection failing overall? All right, that is exactly what we want to monitor right there. And that will lead to the candle direction that will tell us into which next PD array we might want to trade into. Gives us a great indication of what the draw on liquidity overall is as well. What my advice would be right here, focus on 3 instruments. So focus on the daily and the 4-hour time frame right there. That would be my advice. If you want to look at the weekly, etc., that's perfectly fine. Daily 4-hour right there would be my advice though. Then focus on one of the indices. So that can be ES right there. Then focus on as well one of the Forex majors. I would advise pick something like Euro US dollar right there. Then next to that, focus on, for example, silver right there. So focus on 3 instruments, whichever instruments you want to do, of course, that's up to you. This would just be my advice right here. And then from there, we'll see that we will go over as well on Friday in the next video, order flow direction, which again will enhance the understanding of the candle direction as well. If this video does not make sense to you or is quite complicated to you, then again, we have extras tomorrow as well, right? We have live sessions on the day after that exact video to make it more clear as well what we were talking about. And if you have any questions, then feel free to ask them as well in the Discord. All right, perfect. Thank you.